in the Unit 3 Central Banking. Under the Central Banking, let us try to understand on the topic of credit control measures. Myself, Dr. Sreenivasaiah, Department of Collegiate Education, Government of Karnataka. In the introduction part, one of the most important performing function of RBI is to control credit. Normally, this credit will be created by commercial banks. Commercial banks means all the banks which are lending to the public directly. So these banks are creating the credit. This credit will be controlled by RBI depending on the situations in the economy. In the economy, if it is inflationary rate, that is, credit is going to be controlled. If it is deflationary condition, credits are going to be encouraged. So this is the way where RBI, Reserve Bank of India, will take a step to increase or to decrease in the cash reserve ratio, an effective instrument to control credit. Under the RBI Act 1934, Reserve Bank of India is empowered to vary CRR, cash reserve ratio, between 3 and 15%. High CRR reduces the cash for lending and low CRR increases cash for lending. Here I said whenever there is a low rate of CRR, there will be a more money in the hands of banks to lend, and whenever there is a less CRR, obviously there will be a more money in the hands of banks. More CRR, there will be a less money in the hands of banks to lend. So therefore, that is the way RBI is going to control the credit among the commercial banks. See why the credit control is going to be done by the RBI, what are its importance or what are its objective. So that is, let us try to understand. So this credit control method is very important question from the faculty for examination as well as the competitive examinations, and for almost all the examination it is very much needed. Now in this slide, let us try to understand importance of credit control. Why this credit control will be done? To obtain stability in the internal price level or inflation, which means to say that inflation, the expected objective of this credit control is to stable or to control the inflation. To attain stability in exchange rate in the sense how one currency can be exchanged to another country currency. This will be an important function of any international trade. Under that circumstances, so there is RBI is going to maintain stability to encourage international trade by maintaining exchange rate stability. Stabilize money market in the country. Stabilize money market in the country means, so money market, the short term, it is the market which lends and borrows money in the short run, where short term money instruments are being traded. So these short term money instruments being controlled with the help of, that is, by using the tool of rate of interest. To eliminate business cycles, inflation, depression by controlling the supply of credit. So here business cycle, it is a situation of where the fluctuations in economic activities These fluctuations in economic activities will be controlled by Reserve Bank of India through all commercial banks. To maximize income, employment, output in the country, normally RBI is going to maximize by encourage the income, employment and output in the country to meet financial requirement of an economy, not only during the normal time but also during the emergency or war period. Here, any economic situation, any economic circumstances, RBI, which means Central Bank of the country, is going to help for that particular country in the form of supplying the money into the system. If any emergency comes, war comes, Reserve Bank of India will come forward, or Central Bank of the country will come forward for the government to supply the money. To help the economic growth of the country with a specified period of time. Economic growth in the country, normally it will be encouraged by the credit. So, to control credit or to supply credit, so Reserve Bank of India or Central Bank of the country, it will take a necessary step in this regard. Next, methods and instruments of credit control. What are the different methods are employed to control the credit? So the methods of controlling the credit by Reserve Bank of the country is mainly on two types, that is qualitative and quantitative measures. Quantitative measures and qualitative measures. The quantitative measures is also called general methods. These quantitative methods are those aims to controlling the total volume of credit in the system. Total volume of the system will be controlled with the help of the quantitative credit control methods. Under these quantitative credit control methods, so these are the different methods, that is bank rate, open market operations, variable cash reserve ratio, statutory ratio, rationing of the credit, margin requirements, regulation of the consumer credit, control through directives, publicity, moral measures, direct measures. So with these measures, Reserve Bank of India as a quantitative measure, it is going to control the credit. Now let us try to understand by one. Here bank rate. What do you mean by bank rate? Bank rate is the rate at which central bank, that is RBI, grant loan to commercial bank against the government security, other approved first class securities. RBI will adopt two important methods to control money circulation, cheap or dear money, dear monetary policy according to economic condition of the country. Here we need to understand what is a bank rate, which I have told here. Bank rate is nothing but rate at which Reserve Bank of India charges the rate of interest on all commercial bank for its borrowings. Normally, this bank rate will be charged on long-term borrowings by the commercial banks. These long-term borrowings of the commercial banks, again, that is cheap and dear monetary policy, which is being adopted on the basis of economic condition. Here, cheap monetary policy, under this condition, based on the conditions in the economy, RBI is going to reduce the rate of interest. When RBI reduces the rate of interest in the country for the credit, obviously there will be a more money in the hands of commercial banks to spend, which means commercial banks to extend loan facilities. When the RBI reduces the loan in the name of cheap monetary policy, that is, commercial banks are also reduces the rate of interest in the name of market rate, which means market rate of interest will also reduces as a result, there will be a possibility of increasing in the money supply in the hands of individual, so as a result, money circulation in the economy is expected to increase. As a cheap monetary policy, decreasing in the bank rate, there is a decreasing in the cost of credit. So decreasing in the cost of credit, decreasing in the rate of interest, as a result, the quantity of credit increases. When there is a decreasing in the rate of interest, obviously all nationalized commercial banks or a commercial bank are going to increase the credit as a decreased rate of interest. So therefore, we can say that through this cheap monetary policy, when the RBI reduces the rate of interest towards commercial banks, similarly, the same rate of interest, which means less rate of interest, will also to be transferred to the customers through the commercial banks in the name of market rate. As a result, the quantity of credit increases. As increased this quantity of credit, obviously in the economic system, there is an increasing in the money supply. That is which will happens in the system to encourage credit as well. On the other hand, there is a policy of dear monetary policy by RBI. What do you mean by this dear monetary policy by RBI? Dear monetary policy by RBI means RBI increases the bank rate. When RBI increases the bank rate, obviously there is a increasing in the market rate also. With increasing in the market rate, obviously where there is a commercial banks has to lend less towards consumers. As a result, what will happen? There is a decreasing in the quantity of credit in the market. The current bank rate is at the moment 4.25%, which means to say that whatever the loan takes from the commercial banks, from the RBI, commercial banks has to pay off at the rate of 4.25% of rate of interest towards RBI, and whatever the rate of interest they are charging, that is commercial banks are charging more over and above the 4.25%, it will be their administrative expenses and their for other reasons, whatever the infrastructure maintenance they are taking place in the system. This is how the bank rate will act in the system. Bank rate means rate of interest charged by central bank on all commercial bank for its borrowings during the long term lending. This bank rate is broadly categorized. Method is going to operate in the two methods: cheap monetary policy and dear monetary policy. In the cheap monetary policy, bank rate decreases. In the dear monetary policy, there is a bank rate increases. This will be operated on the circumstances or based on the situations in the economy. If there is an inflation, RBI is going to operate cheap monetary policy. If there is a deflation, RBI is going to operate dear monetary policy. This is the way they are going to control the credit through this bank rate. Next, open market operations. Open market operations refers to the deliberate or direct buying and selling of securities, bills in the money market by the central bank. Purchase, selling of securities may lead to expansion and contraction of money in the money market. It influences cash reserves with the commercial banks. Hence, these operations control credit creation power. Here we need to understand. So it is the method of practicing by RBI process of selling and buying securities in the market, which means open markets operations are the process of selling and buying securities in the market by RBI. What will happen during an inflationary pressure? What will they do? They are going to purchase. They are going to, which means RBI, it is going to purchase or buying securities from the market. As a result, what is going to happen? Money is flowing from banks to the central bank. When there is a money is flowing from commercial banks to the central bank, then there will be a less money in the hands of commercial banks to spend. When the commercial banks are having less money, then they will not be able to spend on the direct consumers. So obviously the credit is expected to get contrasted. This is the way through this open market operation, money, so that is credit money, will be controlled. On the other hand, there is a deflationary pressure. This is a situation where there is a less money circulation in the economy. When there is a less circulation of money in the economy, RBI is going to that is buying the securities. When RBI are buying the securities, obviously there is a money flow from RBI to the all commercial banks. When there is a more money is buying towards the market, obviously there will be more money in the hands of commercial bank to expand the credit when RBI buys the securities. Obviously money is flowing from RBI to commercial bank, then commercial banks are having more money in the hands of bank to spend. Obviously what is going to happen? Then they will spend. So therefore money is flowing from, so that is central banks to the commercial banks, then commercial banks to the individual customers. So therefore money flows. This is the way where through the open market operation money flows. Here there was a small mistake which I have done here before. So in the open market operation, so whenever there is an inflationary pressure, they are not going to buy, which means RBI, it is not going to buy. RBI, it is going to sell securities. RBI, when it is going to sell securities, obviously the more money flows from individuals to banks, then banks to the Reserve Bank. When RBI sells securities, banks will purchase securities, then money is flowing from banks to the central bank. Obviously there will be less money in the hands of commercial bank to spend or to create credit. Then obviously this is the way where credit will be controlled. So through this open market operation, that is the deliberate direct buying and selling securities and bills in the money market by the central bank, the credit will be controlled directly and indirectly based on the situations in the economy. This weapon is used to fulfill the seasonal credit requirement of commercial bank. Whenever the commercial banks requires money, under that circumstances where the central bank is going to use this as a weapon to control the money circulation. Next, cash reserve ratio. Cash reserve ratio, the RBI controls the credit through change in the cash reserve ratio. So that is called, this is also called CRR. Commercial banks, every commercial banks are required by a law to maintain percentage of its deposits with the central bank, which is called cash reserve ratio. Here all the commercial banks has to maintain CRR with the central bank. When all commercial banks are maintaining CRR with the commercial banks, obviously based on the situation, depending on the situation, credit creation and capacity of the RBI is expected, of the commercial bank, it is expected to increase. So this is the way where RBI, it is going to act, it is going to change. So based on the situation, the credit that is CRR. So as a result, money that is credit will be controlled. The central bank has a power to change percentage of cash reserve with to be kept with it, which means it has the legal right to change. It has the ratio increases the credit creation in capacity of the commercial banks. Commercial banks decreases. On the other hand, if the ratio decreases, credit creation in capacity of commercial bank increases. When RBI this ratio, cash reserve ratio decreases, obviously credit creation in capacity of the commercial banks it is increases. The ratio can be varied from 3% to 15% directed by the RBI based on the situations of the economy. If it is an inflationary situation, that cash reserve ratio it is expected to be a more. If it is a deflationary situation, the cash reserve ratio with the RBI by the commercial bank it is expected to be higher. Based on the situation, credit will be controlled. By changing the reserve requirement, the central bank is able to affect the amount of cash with the commercial bank, force them into a curtail the expansion of credit. The current CRR, that is cash reserve ratio, is at the moment is 4%. Based on the situations of the economy, this cash reserve ratio it is expected to get changed. Statutory liquidity ratio. Every scheduled bank is required by a law to maintain a minimum of 20% as cash, gold and unencumbered securities of its total demand and time liabilities, which is called statutory liquidity ratio. The RBI is empowered to change this ratio. It is also influence the credit creation in capacity of the bank, which affects both CRR and SLR. The credit expansion is similar on the as on that is October 21st, so 1997, it was fixed at 25% of total deposits of the commercial bank. Penalties are also levied by RBI if it not maintained these ratios from scheduled bank. Current SLR is at 21.50. So here all the commercial banks also required to maintain the minimum statutory liquidity ratio with central bank. This statutory liquidity ratio will be maintained with the RBI. If it is increases, credit creation and capacity of the commercial banks will be reduced. If it is decreases, credit creation in capacity of the commercial banks is expected to increase. At the moment, it is 21.5%. Almost is a minimum of 20% means it is at the lower end, which means governments are thinking of to increase, or governments are thinking of to expand credit in accordance with that. The expansion of credit will take place. These are the methods. So far, whatever the things we have studied, these are the quantitative methods of credit control. Now, let us try to understand the further continuation part, that is qualitative credit control methods. These are used to affect the use, distribution, direction of credit. It is used to encourage such economic authorities as desirable to discourage which injurious for the economy. RBI from time to time adopted the following qualitative methods credit control, which means qualitative credit control methods are the methods employed by Reserve Bank of India towards all commercial banks to encourage economy without having any kind of injuries to the economy. What are these important measures which has been analyzed like this? That is rationing of credit, margin requirement, regularization of consumer credit, control through directives, publicity, moral solution, that is moral measures, direct action. that is direct measures. So these are the different methods are employed. Now let us try to understand all these different methods as a qualitative credit control measures. Rationing of credit. Rationing of credit. In this method, RBI seeks to limit the maximum or ceiling of loans and advances, and also certain cases fixes ceiling for specific categories of loans and advances. It aims to control, regulate the purpose for which the credit is granted by commercial banks. The variable portfolio ceiling. According to this, the central bank fixes a ceiling or amount of loans and advances for each bank, that is, bank cannot advance loans these behind this limit, which means here RBI fixes a kind of a limit for the maximum ceiling of loans. This is on portfolio, variable portfolio ceiling. Behind this, no bank is supposed to lend loan. Under this, here again, the variable capital asset ratio. This is a ratio which central bank fixes in relation to capital of a bank for its total assets. So under this, the variable capital assets ratio also, based on these assets, the Reserve Bank of India will fixes the credit extension or regulation towards the commercial banks. Change in margin requirement. So here change in margin requirement, it is one of the most important thing. Margin refers to the differences between current market value and the loan value of a security. Say for example, you are an individual. When you wanted to take loan from a bank, which means from the commercial bank, you are going to keep a kind of a gold of 1 kg of gold, which cost at present, say for example, 30 lakhs rupees. You are putting this as a security, as a security towards your gold. So that is, banks, based on the situation, the margin they are going to maintain more when there is an inflationary situation. When there is a deflationary situation, margins are going to maintain less. As a result, the credit will be managed in the system, which means for a 30 lakh, sometimes they can give only 50%, that is on 15 lakhs of loan for 1 kg of gold. On the other hand, sometimes when there is a deflationary situation and when there is no arm to the economy, under that circumstances, they can go to 20 lakhs, 22 lakhs, 23 lakhs, like that. Based on the situations of the economy, this is going to be changed. A margin requirement of a commercial banks do not lend out money full amount of the value of the security. The loan amount is less than the security value, so therefore it keeps the margin as a cushion against fall in the value of security. Why this margin has to be maintained? This margin has to be maintained as a cushion against fall in the value of a security. So margin refers to the difference between the current market value and the loan value of a security. It is the portion of a value of security charged to a bank which a borrower is expected to pay out of his own securities, own resources. As a rise in the margin requirement restrict the amount of loan that bank can grant against security, while lower the marginal increases its the way to the amount of fixing margin requirement. As a direct impact on the amount of credit for speculation purposes, during the depression, the margin can be reduced to the extent where then economic activity to encourage. In increasing in demand for a bank credit, that is conversely, during the inflation, margin requirement can be raised by the monetary authority so as to contain boom the stock market as well. So therefore, change in the margin. When the change in the margin takes place in the system, obviously there is an expansion and contraction of credit can be undertaken. So through this change in the margin, to say in few sentences, That is, when commercial bank takes as a security value for the extension of a credit, this asset complete loan amount is will not be given, so that is total value of security. So they are going to maintain certain amount of margin based on the situations of the economy, that is whether it is inflationary or whether it is a deflationary. Next, regulation of consumer credit. With the introduction of installment trading, that is trading on non-essential consumer goods like motor vehicles, electrical vehicles, electronic goods have gone up an unpredicted level. The RBI may restrict these consumer expenses on non-essential items by directing that is commercial banks to fix minimum percentage of down payment, length of the period also over which installment payment may be spread. So here we need to understand that regulation of consumer credit. So that is based on two methods we can understand here: direct consumer goods and indirect consumer goods. Here, based on the, if any good it is linked to a production. If it is linked to a production, again that has been a chain, that is production, again it is going to encourage that is producer. The producer is being encouraged again in the name of employment. That employment again will be encouraged in the name of again raw material usage and so many other things. As a result, a buyer, this regulation is going to take place on the regulation of consumer credit based on the situation in the economy. Suppose to buy a washing machine, a buyer is required to make down payment of 1/4 of its total price. The rest is to be paid by 15 equal monthly installment. Under this regulation, consumer credit is the down payment amount may be increased, the number of installment reduced. This reduced demand and product control consumer spending, which necessary for controlling prices. During inflationary condition, more restrictions can be prescribed to control prices by controlling demand. So while during depression they can be relaxed in order to stimulate demand for goods and services. Very recently, that is in the month of October, Reserve Bank, the Government of India has announced a scheme called production linked consumer demand can be encouraged. So banks are going to give loan facility for the credit linked directly to the production. Obviously, there is an increasing in the employment, so there is a increasing in the demand for raw materials and other activities will be encouraged. Keeping that is in the mind, this regulation will take place. Control through directives. Here, control through directives means RBI have been empowered to issue directives to commercial banks to respect their lending policies. Purposes for which loan may or may not be granted, margin to be kept in the case of secured loan. The power of issue directives may be given either to that is to statute by mutual agreement between the central bank and the commercial bank. Directives may be issued to encourage flow of credit in certain area and to sometimes to prevent flow of credit into undesirable directions. Here, Reserve Bank of India also give directions to the commercial banks to issue loan and not to issue loans. If they wanted to issue loan by giving the directions, so that is going to be, then be some meaning is involved in it. On some time when there is a directions not to issue loans on some areas, under that circumstances there will be a no like a direct production linked areas. So that is the way these commercial banks are going to direct its commercial banks. Further, publicity. RBI may follow the policy of publicity in order to make known to the public its view about credit expansion and contraction. So therefore, RBI regularly publish statements of assets and liabilities of commercial bank for the information to the public. This will also publish reports, general money, market, banking conditions. This is the way to that is exerting moral pressure on commercial bank, also making public aware about the policies being adopted by bank, the commercial bank, in the light of prevailing economic conditions in the country. About the commercial banks, Reserve Bank of India will also publicize their assets and liabilities and their status of credit and the status of borrowing. With all these things, the credit creation, credit control will be done by the RBI, Reserve Bank of India. Moral measures. Reserve Bank of India will also advise on the request made by the central bank to the commercial bank, follow up monetary policy and carry out their lending activities and other operations as they may achieve the objectives of the central bank's policies. So here, if any bad conditions are there in the economy, Reserve Bank of India advises to its commercial bank not to issue loan, not to grant loan. Under that circumstances, they are going to understand the situation and pressure and persuade the commercial bank to follow its policy. On the other hand, when there is a situations are very bad, under that circumstances, extend loan facility even by taking the risk. Obviously, there will be a more that is extension of economic activity as by taking the measure of moral measure by the central bank on commercial banks. Further, direct action. Here, sometimes RBI can take a direct action on commercial bank if they doesn't follow the directions issued by Reserve Bank of India to follow the credit guidelines. These lending and other investment. RBI may refuse sanction of further accommodation to a bank, and RBI may reject altogether any application for the grant of discounting facilities to a bank, and it may charge penalty rate or interest on loan taken by the bank behind the prescribed limit. So here, and the various direct measures can be taken by if it is not followed by all commercial bank the instructions given by Reserve Bank of the country. These are the different methods being adopted to control credit. In conclude, modern time, bank credit to become an important source of money, and commercial banks have unlimited power to expand on contract credit for smooth functioning of the economy. RBI controls the credit through qualitative and quantitative methods and encourage credit for productive purposes and discourage credit for non-productive purposes. This is the way where Reserve Bank of India will control the credit. Anyway, it is one of the important function as well in the in the central bank of the country by controlling the credit. So this is the way we need to understand. Thank you very much. Please do subscribe the channel and learn well.